Well, the big news out today, those inflation figures coming in at 4.1% in the month. What did you make of those numbers? Is that the kind of number you had expected to come through?
Good afternoon, Mashudu. This is in line with what we would have expected. The good news here is effectively that we are perhaps at a very low level. We are perhaps at very close to the trough when it comes to looking at inflation within a cyclical context. What this means to us is that there's perhaps a higher possibility or probability that the MPC could be cutting rates by about 200 basis points. Inflation coming down and rates coming down as well is perhaps good news for duration if you're still in the fixed income arena. But as we've said before, for us, clearly this is time away from fixed income into equities, and we continue to reiterate our view that this seems like the right time to get into equities.
Indeed, you're seeing a bit of a fall off in inflation at this stage, but a number of commentators have been talking about risks that are likely to come through, given the fact that food as well as fuel prices. What is your outlook then for inflation for the rest of the year and into 2013?
Well, the reality is that these levels are very low, certainly within the last 12 months, or the context of the last 12 months at least. And if you look at the sort of bandwidth we should be in, or we should be going back to on a normalized basis, anything around 5% may make sense. And in that sense, maybe food inflation, which has been a bigger problem in Kenya, does not seem to be as important as it was in the past. And oil, well, it's more of a global issue than just one for Kenya here.
Now, you touched on equities as well as fixed income, saying that the decrease in inflation could be better for fixed income assets at this stage. What do you make of the increase that we are seeing in the rates coming through? We saw a 182-day auction that came through today. At the last auction, it was a rate of around 10.76, with some saying they're seeing further increases to that rate going forward.
We would not, as a house, we wouldn't dismiss a small sort of correction in the rates right now, but the glide path itself is very clear. As I said, we still have an MPC to come. Let's see what they come up with as a rate cut. And this is actually a bigger driver for us, and certainly when we're looking at equity research or equities across the market, that is a bigger driver to us than sort of perhaps the last auction.
And we've got KCB out with results that was in last week's trading session. We saw an increase in pre-tax profit of about 43%. What did you make of KCB's numbers? And perhaps could we see this kind of numbers coming through for the other banks that are due to report?
At least for the big five banks, it wouldn't be entirely surprising to see this sort of numbers. What I make of KCB's numbers is that they were broadly in line with what we expected. The reality is that when you look at quarterly numbers, so the new numbers, there is a sense that we are close to the peak, certainly if we're looking at the past 4 quarters or so. What is important for us here is to keep focusing on trends. Yes, earnings might still be coming through, and mostly through non-interest income. But we would still keep a strong watch on impairments, ex recoveries, and we'll keep a tab on capital and each bank's ability to actually pay dividends, and also to be able to take advantage of what we expect to see a return to loan growth in the near future.
Do you have any risks perhaps for the banking sector at the moment, something that you look at and say this is what we need to watch out for?
Well, broadly speaking, there is always downside risk in any stock, but at this stage, we believe that the macros and the performance so far are perhaps outweighing any risk. I wouldn't dismiss any any accidents, if you want to look at it that way. But roughly where we stand now, we are in a much more stable environment than we were a year ago, and the macros are helping.